Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome to the show. Josh, a single buyer took down all $400 million of Blue Owl's bond issue. And the market didn't say, nice allocation. It said, who's rescuing whom? That reaction matters. Ordinary bond deals get distributed. They get carved up. They get price discovery. When one firm, PIMCO in this case, buys the whole thing, the first question is not about demand. It's about motive.
Yeah, the $400 million is the first tell. If this were just a plain vanilla strategic opportunity, you'd expect a book, a handful of accounts, maybe some oversubscription chest thumping. Instead, you get one whale swallowing the whole fish. And when one whale does that, I stop underwriting the bond first and start underwriting the relationship.
Exactly. And then you look at the pricing, a 6.4% yield, about a 255 basis point spread over treasuries. That is not where the happy talk about premium private credit platforms would lead you. If the story is strength, scale, pristine sponsorship, why are you paying a spread that makes people lean back in their chair?
Let me grab that 255 basis points because that's the number that sticks. 255 over treasuries is not everything's fine, move along. That's the market saying, I need to be paid for something more than routine risk. And when that thing sits next to pure private credit pricing, it looks wrong. Like the thermometer is reading 104 and everyone's saying, maybe the room's just warm.
The financial media does love a warm room theory, but bond markets are less sentimental. They price suspicion before they price headlines. If investors truly believed this was a normal, opportunistic issue, the structure would have looked normal, the placement would have looked normal, and the spread would have looked tighter. Instead, the entire setup screamed exception.
And from a practitioner's standpoint, exception is where you make or lose your year. I mean, I've sat in enough credit meetings to know the dangerous phrase is unique situation. Usually that means someone's about to explain why a weird trade is actually safe. That's when I check if my wallet's still in my pocket.
Fair, but let's sharpen it. The core question is simple. If this was merely attractive paper, why did one buyer take all of it? Because concentration changes the interpretation. It suggests either the broader market didn't want it at that level, or the buyer had reasons beyond coupon income.
Right, and those reasons matter more than the 6.4% itself. 6.4 sounds decent if you say it fast. But the issue is not whether 6.4 is income. The issue is why 6.4 had to exist for this name in this size with this buyer. You don't just ask, is the bond cheap? You ask, cheap relative to what pressure?
And that gets us into the larger problem. Because once the market smells that a trade may be doing two jobs, financing an issuer and stabilizing a situation, it stops treating the bond as a standalone object. It starts treating it as evidence.
Evidence is the right word. The tape may say bond deal. The market may hear support operation. And once people hear support operation, every other private credit mark gets a little less trusted. This is where the bigger cycle shows up. Higher for longer rates are not some abstract macro slogan. They hit middle market borrowers right in the cash flow statement. Debt service goes up, EBITDA doesn't magically cooperate, And suddenly, everybody's best friend is amend and extend. You kick the can, stretch maturities, pray the business grows into the capital structure, and call it proactive management.
Proactive management. That's one way to say it. Another is refusal to recognize impairment. And the mechanism matters. When borrowers can't comfortably pay cash interest, one adaptation is PIK, payment in kind. Interest accrues instead of getting paid in cash. On paper, income exists. In reality, liquidity is weaker.
That PIK number above 12% in some BDC data, that's the one people shouldn't brush off. 12% plus PIK is not a rounding error. That's not seasoning. That's the chef covering a bad steak and sauce. If a meaningful chunk of your income is non-cash, the portfolio may look stable right up until confidence breaks.
And pair that with BDCs trading at large discounts to NAV. The discount is the market's editorial comment on those marks. Public investors are basically saying, we don't believe the stated net asset value is what you say it is. That's not a healthy market. That is a trust problem wearing an accounting costume.
Let me try to explain that back. A BDC says, our NAV is X. The stock market prices it materially below X. So public equity holders are not waiting for actual loan defaults. They're discounting the possibility that marks are stale, future losses are coming, or income quality is softer than advertised. Is that fair?
Yes, almost. I'd add one thing. Public markets do not need a legal default to declare distrust. They reprice the vehicle first. That's why the Blue Owl trade matters beyond Blue Owl. It's a lens. It shows how confidence can deteriorate long before covenants formally snap.
And that's the part retail investors miss because private credit gets marketed like a calm lake. No price quotes every second, no ugly red candles, no CNBC sirens. But the absence of a mark is not the absence of risk. It's just less frequent embarrassment.
Very well put. Illiquidity can disguise volatility. It cannot abolish it. Higher rates expose weak borrowers first, then weak underwriting, then weak reporting. It moves in layers.
Which is why I keep coming back to the same boring banker question. Who is actually sending cash? Not accrued income, not adjusted EBITDA, not sponsor support, not some rosy exit model. Cash. If the answer starts getting fuzzy, your supposedly stable book may be one rough quarter away from a reputation problem.
And reputation in this sector is not cosmetic. It is transmission infrastructure. Once investors suspect that PIK is substituting for payment discipline and that NAVs are lagging reality, every future fundraise gets harder. Every financing line gets more expensive, and every isolated issue gets viewed as a template. Now we get to what I think is the central issue. The bond itself may not be the real risk. The reported $1 billion NAV-based financing facility to Blue Owl's GP Stakes Fund 5 is where this starts to look different. If that facility is collateralized by fund NAV and tied to a 60% loan-to-value covenant, then the sensitivity is not just credit spreads, it's valuation marks.
That 60% LTV covenant is the hinge. 60% sounds conservative until the V starts moving. If NAV gets marked down, even modestly, your loan-to-value jumps without the borrower touching the steering wheel. That's why NAV lending makes me itchy. You're lending against an appraisal of appraisals.
An appraisal of appraisals is good, and it captures the recursion here. If the underlying assets are private, the NAV itself is model-driven. Then leverage is built on that modeled NAV. Then a public bond purchase may, indirectly, support confidence around the platform that influences those marks. This is not a simple security analysis anymore.
Right. This is platform risk. That's the phrase people need to remember. Not just is this bond money good, but does the platform need oxygen? Because if I'm a lender on a $1 billion NAV facility and I'm staring at a 60% covenant, I care about anything that reduces the chance of a markdown spiral, a fundraising hiccup, or headline damage that causes everybody to second guess marks.
And that may explain why a public bond purchase can function like indirect protection for a private financing exposure. You don't have to explicitly rescue the facility. You can stabilize the broader organism around it. That is why one cannot simply say, PIMCO liked the yield. Maybe they did, but yield alone is an incomplete explanation.
Let me push on that. Are we saying the bond was bought to protect the NAV line?
Not exactly. That'd be too neat. But are we saying if you already have exposure through a NAV-based facility, then supporting confidence in the issuer and platform could be economically rational?
Yeah, that I buy.
It's the difference between underwriting the brick and underwriting the whole building.
Correct. And in private markets, that distinction is often ignored until stress arrives. People pretend they own isolated exposures. In reality, they own a network, sponsor reputation, fund marks, financing lines, distribution expectations, legal overhang, fundraising momentum. Stress travels through networks.
And once you see it that way, the bond stops being the main character. It's more like the scene in the movie where a side door opens and you realize the house is much bigger and less stable than you thought. I've learned this one the expensive way. When a deal starts forcing you to underwrite management optics, lender behavior, and mark methodology all at once, you are no longer buying a tidy instrument. You're insuring a story. And liquidity can keep that story alive for a long time. That's the uncomfortable piece. If cash comes in through a bond deal, distributions can keep flowing. Visible stress can be deferred. And people can tell themselves the machine still works. That does not make it a bellwether of strength. It can make it a bailout with better tailoring.
Yes, liquidity often delays recognition. It does not cure insolvency, and it does not erase overvaluation. What it can do is postpone the moment when public evidence becomes unavoidable. In that sense, the market may be defending time as much as capital.
And Blue Owl's legal and reputation risks matter precisely because private credit runs on confidence almost as much as collateral. That's not me being dramatic. In banking, if depositors trust you, you get time. If investors trust your marks, you get time. If counterparties trust your platform, you get time. Lose that, and all the elegant deck slides in the world won't save you.
This is the part institutions routinely understate. They speak as though collateral alone governs outcomes. No, confidence governs funding, funding governs flexibility, and flexibility governs whether problems remain manageable or become visible. That chain is especially important in private credit because pricing opacity masks deterioration until it doesn't.
That phrase, until it doesn't, is the whole game. People hear private and think protected, but private just means the smoke alarm has a slower battery. By the time the noise starts, a lot of oxygen may already be gone.
And so the unsettling possibility is that the real asset being defended here is not the bond, not even the fund, but the sector's self-narrative. The narrative says private credit is resilient, well-structured, senior in the capital stack, insulated from public market noise, perhaps. But if support transactions become necessary to preserve that perception, then perception itself has become systemic collateral.
Which leaves investors with a nasty question. If a 6.4% bond bought in one $400 million gulp can calm nerves around a platform tied to a $1 billion NAV facility with a 60% LTV tripwire, what else in private credit is being held together by confidence that hasn't had to face a real mark yet?
That's the question. Not whether a deal got done, but what the deal had to protect. Thanks for listening.
Go read the footnotes before the footnotes read you. See you next time.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.